Hello again, and thank you for joining us. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for the end of the first quarter, 2026. Today is March 31st, 2026. It's our market update and outlook for our clients at Blanke Schein Wealth Management. A lot has happened this first quarter. It definitely wasn't on all that's happened so far wasn't on the bingo card as we started the new year, but we'll go through it. And thank you for joining us. It's got about 15 slides. I'm going to try to get through it in about 20 minutes. And then if you want to pause, go back, share, like, subscribe, you can do all that fun stuff as well. But what I start with is the frequently asked questions in this presentation, as well as what to watch. So the first one, we're going to talk about first point, our markets, earnings, Fed, inflation, and the U.S. consumer. The second bullet point should be number one, actually, is the geopolitical events, which stole the headlines and weighed on the market the most, and the historical market outlook. It's always good to put markets in perspective as we go through events like these. Number three, what sectors in the market are most attractive for our investors, and what's our process? How are we taking advantage of it? How are we protecting on the downside, but also how are we capturing moves to the upside, and what sectors are actually moving as well. Number three, will the U.S. enter a recession? That's always a question that the clients are asking. So we're going to address that. Number five, what should investors be watching over the next 6 months? Now, we're long-term investors of Blanke Schein Wealth Management, as well as everything that we do. But at the same time, clients always want to know in the next 3-6 months, what should we be concerned about? What's on our particular radar? And what are we going to do about it? So let's get into it. What do we do now? It's a crazy time in the world today. Now, if you haven't seen this broadcast before or an in-person presentation, I've had this slide for the last 5 years, if you will. I've updated the U.S. strikes in Iran and the midterm elections, but everything else that you see has been updated periodically. But it's really, at the end of the day, the rolling concerns that are always there. There's always clouds on the horizon. There's always something to be worried about. And there's always something, if you tune into the 5, 6, and 10 news, or even open your Twitter feed, something to be concerned about. How do we navigate through this? What do we do with our clients as we invest and work our way through markets that are always going to have something to worry about? Well, I'd love to use this first trust slide. It literally depicts the S&P 500 since 1970. You can bring it all the way back. But on this slide, it shows the growth of $10,000 invested at the beginning in 1970, and the growth over that period of time to $3.5 million, right? Reinvesting the dividends, staying invested, not being spooked by the headlines. And on the headlines here, you have all of the pertinent things, not all, but a lot of the biggest headlines that weighed on the market year over year, calendar over year, or calendar year over year, and then decade over decade. And obviously, most recently, the Iran war that we're currently in. What you're noticing most is the market climbs the wall of worry, and there's certain components to make the markets propel higher from where they are, and we're going to discuss that today. But the average rate on the S&P 500 over this period of time is 11%. So just keep in mind that investors get paid to wait and be patient and not be so reactive or using sort of behavioral finance emotionally and then pulling money out of the market when it might not be the best time to do so. This is another slide I use for our clients from an educational standpoint, again, by First Trust, and it's all about staying the course as I just described. This slide depicts the S&P 500 year-over-year calendar returns, and it goes back to 1980 through 2025 in the far right. And what you're going to see is, and if you sat down with me personally in one of our meetings, or you, again, been in a presentation, I usually use this slide. And really what it shows is it's not uncommon for markets to pull back. In fact, every single year, markets pull back by 5%, 2 to 3 times a year, and 10% by usually one, and maybe 20%, maybe every 3 to 5 years. And that's technically a bull or bear market, if you will, if we hit the 20% mark on the downside in that calendar year. But what you're going to see is on this particular slide, the inter-year declines. So you have every calendar year, and I'll just pick out one for us right now. Let's go back to, I always love to pick this one out, 1987. So we had Black Monday. The market was down by over 30% in October, and it was down 34% at the market low in that intra-year in 1987. Most don't realize or remember that the market actually ended up 2% that year. And here's, let's see if I can get my laser pointer right here. So this is the year I'm talking about, 1987. The market was down, drawdown by 30%, which was substantial and significant, especially in that year proportionally to where we are today on the market. But these are all the years where the market drew down, if you go through this. And there's been some years where in 1998, the market was down 19% intra-year, but ended up at the end of the year, 27%, if you will. If you remember the 1990s, you have a substantial bull run from 95 on, 20% plus year, actually 27% plus average year every single year in the 90s. But don't kid yourself, the market was down even in the 90s through that go bull run. Right now, last year, if you remember, we had April 2nd. It's when Trump announced tariffs. Market was down 19%. We didn't hit the 20%, which would technically be a bull market, but inter-calendar year, we hit 19%, and market did end up last year 16%. So stay the course, and it's important to know volatility is normal. So war, what is it good for? A couple of key questions what are the key U.S. objectives, and are they being met? Well, there's many objectives. President Trump put out a 15-point plan to end the war, and I think that's going back and forth in terms of conversation. As we just started the broadcast right now this afternoon, there was a CNBC report saying that Trump says in a report that he wants to end the war within 2 to 3 weeks. Earlier today, we had the market, the Dow rallied over 1,000 points. The markets were up almost 4% on the Nasdaq and 2 to 3% on the Dow, or the S&P and Nasdaq, or on the Dow as well. On the talks that yes, the war could be coming to a close, but in the meantime, what are the objectives? And the objectives is leadership change, getting in control of the weapons, uranium enrichment, Navy, everything else. So from a military standpoint, a lot has been done. And what are the objectives? No one really knows what the end is and the end game is and the end timeline. As I said before, the market jumped anywhere from 2 to 4% today across the respective indices based upon CNBC news story or unconfirmed reports. That could change tomorrow. Keep in mind, we also have quarterly rebalancing. Markets have been down. S&P is down 7% this quarter. The Nasdaq's been down 7%, S&P down 4.6%, and the Dow 3%. But they jumped today, and that's because a lot of institutions, a lot of rebalancing has happened at the last day of the quarter. So there's been bargains that have been purchased, if you will, and that's why you stay the course, as I said before. The second question is, what are the key impacts to the global market, both short and long term? Well, I can tell you this, on the short term, negative, right? We're going to see higher oil prices, higher energy prices. We're seeing that in the US and globally. It's impacting our kitchen table economics, your wallet, our wallet, as long as a lot of other negative effects short term. Longer term, markets are seeing through this. That's where we're seeing different days where we're seeing a bid in the market. We're seeing sort of positivity that's looking longer term. Markets day to day are open to price in news stories, but longer term look towards the horizon. So global markets could be seeing an end at some point in time, and then the oil markets could see an ease. Oil's over $100 a barrel still as we speak right now, which is not positive. The longer we stay there, the more chance there is that the U.S. would hit a recession. The reason why it would hit the consumer, which is 2/3 of the GDP spending, as well as earnings on the corporate balance sheets. So that is a risk that we do have to pay attention to. But ultimately, our sense is that President Trump understands that the options for retaking the Straits of Hormuz come at a heavy cost, and it's going to be highly impactful from a military standpoint, from a even putting our U.S. troops and other troops around the world in jeopardy. So we really believe that there's going to be a deal, and there's reasons to support that. In fact, that CNBC report just now and markets jumping today point that out and point to that direction. Let's hope that's the case, and that's the direction we're moving from this point forward. Here's one of the slides that so even though there's a geopolitical event, even though there's war, even though there's a disruption, that's not the distraction that we pay attention to at Blanke Schein Wealth Management when managing clients' assets, both short and long term. What we pay attention to are things that could really impact negatively the economy, corporate balance sheets, and consumers longer term. And I've used this slide many, many times. If you've been a student of finance, you know the great economist Milton Friedman, and he has some of the greatest quotes of all time. He says, I'll just read a few of them here. Inflation is caused by too much money chasing too few goods. We saw that during COVID when we had the stimulus. We had all that money dumped, but we were staying at home. Into the stimulus dumped in the economy. We were staying at home. Both consumers, small business, and even the local governments had this money pent up, but you couldn't get any good. And there was no service to actually go out and travel. Travel took a few years after the pandemic, after we opened back up. But then you had all this money in the system chasing, and that was during the inflationary problem that we're still working through today. We believe it's going to be a decade to burn that off, because there's still underpinnings of inflation. He also said that if you put the federal government in charge of the Sahara Desert, in 5 years, there would be a shortage of sand. That's absolutely true. Another quote I love is, nothing is so permanent as a temporary government program. Again, spending that is temporary, but is now longer term. We've seen that in many of the government programs. And inflation, his last great quote here that I have, inflation is taxation without legislation. So here's another chart that, again, I used by First Trust for educational purposes, and it shows price changes. If you follow the consumer, the CPI is what it's called, it's government read, of a basket of goods and services basically in our economy, and is priced on a monthly basis, reported by the government. And it really talks about the price changes of wages and services and goods in our economy. And it essentially, on a short term, things like X food and energy, because it's very volatile, but if we add those back, it is very volatile on some of these things. But if we look at longer term trends on this chart, this teases out the different areas that we can see in the CPI. Again, I call it CPIU. What you and I spend money on our kitchen table really matters most. That's why we invest, because we have to stay ahead of that. And here's what I'm talking about. The CPI is anywhere from 2 to 3% in terms of where it's running. It's around 2.5% right now. And that's where the government, or that's where the Federal Reserve wants it to be. But if you tease out the different sectors within there, or different areas within that reporting, you'll see longer term trends that aren't very positive to what you and I spend money on. The first one on top, that blue line, is healthcare, hospital services, healthcare. And what that line is showing is a double-digit rate of return over the last, since 2000, over 250% increase year over year. That's probably one of the most consistent lines that we've seen. And right underneath that is college tuition. I've got 3 college age kids. So you and I are spending money on medical health care, as well as college tuition. And that's a double-digit rate of inflation. That's why we have to invest our money to get ahead of inflation, number one. But number two, get a higher rate of return so we can have better affordability for the things on our kitchen table. We're just living life to keep our same standard of living. On the bottom there is that bottom blue line is TV. So I love Costco. I love go shopping at Costco. As soon as you walk in, you see all the biggest and brightest and cheapest TVs. The inflation, the TVs get bigger, the prices get smaller. But raise your hand if you buy a TV every single month over a month. The answer is no, you don't. Raise your hand if you're spending money on college, let's say for me, for my kids, or even medical month over month. The answer is yes. Again, another reason glaring why the government reporting of what inflation isn't truly accurate because there's a disproportionate spend of your wallet share and my wallet share to things that are much higher than the current blended inflation rate as we see in the CPI reporting data. This is what I think about. This is what we worrying about. This is what the new Fed chair is worried about. This is what the current Fed chair, Jerome Powell, is worried about, which is, historically speaking, inflation comes in two major waves. And this is going back in the data of the major inflation bouts that wreck the economy, that wrecked really good bull markets. And this could do that if this trend were to persist, where we're monitoring it in terms of where the inflation rate is today. Is it benign? Is it staying and holding steady? Is it anchoring? Federal Reserve Chairman earlier this week said he does see inflation currently being anchored to his liking, so they're monitoring it month over month. That's a positive right now. The other lines, besides the blue line of where we are today, the other lines are showing going back to 1910, 1939, 1972. Those are the other lines. And what those other three iterations show is that inflation over those periods of time have had we call the double hump of the camel. And if we see this inflation that started back in 2020, 2019, if you will, we're coming down off this slope. So we did see inflation come down, but prices are still higher than when we started. That's why you and I and the affordability index is still up there. But the question is, if we start turning back and mirroring these other 2-3 times in history, that's what I worry about for long-term effects on our portfolios. That's when we have to be worried. So inflation is the most important thing that we pay attention to, and that's why I wanted to bring in the forefront of the attention for our investors. From a structural technical analysis, clients ask us all the time, Rob, but how are you not worried by the markets themselves? It's because there are some technical aspects that we look at, the moving averages. This is the 50-day and the 200-day of the S&P 500 over a 3-year period of time. The S&P 500 is this line right here on top. The orange line is the 50-day, and the blue line is the 200-day. Now, admittedly, on the 1-year mark, which most don't look at just the 1-year mark, you take a longer term horizon when you do some technical analysis on the S&P. We have dipped even below the 200-day on the 1-year mark. But if we take a longer term perspective, as we do, as investors do, you want to make certain that this S&P 500, the index where we are today, does not get close to this 200-day moving average over the 3-year time frame. If it does, again, probably is because inflation is rearing its head. That means that the market is literally sensing out and teasing out that there's structurally longer term issues. It's not. It's hanging around the 50-day moving average, and potentially, even if it drips below and closes below on a 3-year mark on the trailing 3 years, on the 50-day, that's okay. But if it starts getting closer to, like back in April of last year, starts getting closer to the longer term 200-day moving average, that's structurally concerning. Right now, technical analysis is showing and indicating that we are still in good standing. And that's another reason from our process, what we're watching, what we're paying attention to for our clients, why we're seeing things hang in there. It's not just about the stock market, it's about the bond market. And the bond market very specifically is the first indicator of if there's a major issue structurally. It teases out the inflation. It teases out a lot more than just if something's wrong, a lot quicker and faster than the stock market. So most investors are watching the stock market. We watch the 10-year and the 2-year treasury a minute by minute when the market opens. And that's our indicators, again, from a technical analysis standpoint, from inflation rate and interest rates as well. So a big key component last Thursday actually showed that the 2-year treasury hit a top of close to 4%, but now it's at 382 right now. Actually, it's down under 380 as we close today, which is very positive. We believe that there's a top in the short-term interest rates. This is a short-term interest rate indicator on the 2-year treasury. If it continued to be persistently higher, that was pushing pressure on the market. That's why it was indicating inflation is ahead of us and there's an issue there. But this has rolled over, and that's a very positive side, especially when it comes straight down like this. So keep an eye on the 2-year US Treasury, and that's telling us a lot. And it's also, here's the Fed funds futures. So these two are moving in tandem. Again, that's a positive for the market from what we are paying attention to, what matters. Now here, let's talk about the correction that we've seen recently. And it's not really a big correction, but it feels like it because we had such great 3 years in a row of great performance on the S&P, the NASDAQ, and the Dow. We're going to talk about the correction, the valuations, and earnings. Number one, what we're seeing and experiencing is a rotational correction. Robert, what does that mean? Well, by that means both the NASDAQ and the S&P are in rotational correction phases. And let me give you an example. The NASDAQ's index level at the lowest drawdown in the first quarter of this year was down 13% at one point in time. But a lot of the individual stocks, think the Mag 7s, even Microsoft was down 35% at some point in time. Apple's, Amazon's, and a lot of those, the individual basically constituents, if you will, inside were down about 33% inside that basket, more than the average. And S&P, as an example, was down 9% at the low, but the inside, if you look at other sectors, they were down 18%. So it means that not all sectors are moving down. If you look at S&P, energy's up, industrials are up, other sectors are up, even though technology is down significantly. So it's not hitting everything at a one felt swoop. And that's a very positive sign. It's rolling through different sectors at different times. That's why we're balanced. That's why we're diversified. That's why we have healthcare and industrials and energy. Energy 2 years ago and last year didn't do very well in our client portfolios. And relative to, they were positive, but relative to everything else. If you're getting 15, 20% in the technology sector, you're looking at the money that we had in the energy sector saying, hey, Rick, Rob, Madison, why do we have that money exposed to energy? Why don't we just put it all into technology? The answer is because of this year. Technology is down significantly in that sector. Energy is up significantly in that sector. In fact, energy is up 30%. Technology is down 30%. That's a 60% divergence as you're seeing. And that's why we're balanced. That's why we're diversified. And we be patient. Even though it's not working at that moment in time, doesn't mean that we don't want to chase returns. We don't want to have to sell it over here and then buy it over here before and hit capital gains. We're just diversifying our basically in different sectors, as we know. Valuations, technology is back in line with earnings expectations now, which is a very positive sign. Let me try to move this here out of my way. And we're seeing what's let's see here. See if I get my laser pointer. And we're seeing what is called value compression, not earnings deterioration at this moment. So valuation compression is what we're seeing. As an example, the forward 12-month PE ratio, price to earnings ratio for the S&P 500, another sort of component that we look at to see the valuation of the market, was at 23.3%. Start of the year. Now it's down to 19.9, and that PE ratio relative to the 5-year average is right in line with the 19.9. And it's still a little bit above the 10-year average, but it's right now in a good fair valued standing relative to where the averages are. That's another good positive from a valuation standpoint. Now, valuation is a terrible trading tool. So we don't use it from indication of, okay, we're going to jump in today. But it is one of those things that we do pay attention to. The third component I want to discuss are earnings, an upward revision in earnings. Did you know, and I bet you didn't, that 10% of the S&P 500 has issued upward earnings revision just in this quarter? All the things that we've seen geopolitically with higher energy costs, everything that's going on, the number of S&P 500 companies that are issuing positive guidance for the first quarter of 2025 is actually above the 5-year average. So we haven't seen sort of positive upward guidance momentum on earnings in terms of just companies coming out and actually being more positive than even negative. We haven't seen that in over the last 5 years, actually. Now, what matters most, if you ask us, what matters most are earnings. We've always said this. We always keep an eye on earnings. And now we're going to have, starting April 1st, we're going to have the kickoff of the next 2 to 3 weeks. Corporations are going to talk about earnings, how they navigated through this challenging environment. What were the input costs? What are the wage inflation costs? What is the energy component to their short and long-term businesses? What's their CapEx spending? What are they going to be concerned about moving forward? Are they making money in both top and bottom line? And as I said before, markets are really reasonably priced today. So if we get any upward surprises, markets could see higher for the second quarter. Remains to be seen. What's going to tell that story in greater detail is what the earnings growth looks like. Again, I bet you this is another fact you didn't know, that when we started the year, the forecasted S&P 500 growth rate for earnings was 12.8%. Right now, that's been revised up, not down. So earnings are getting stronger to 13% growth rate for the S&P 500. That's head scratching, given all the negative headlines that we've seen. And I think that's important for me to point that out. And if this happens, which we believe it will, double-digit earnings growth rate for the first quarter of 2026, this will be marking the 6th straight quarter of double-digit year-over-year earnings growth reported by the S&P 500. Again, solid economy, solid earnings. That's something that markets are paying attention to. We're going to be paying attention to as well. Keep in mind, I talked about interest rates earlier, and this is just rudimentally fundamental. Earnings are more valuable when interest rates are moving down, and earnings are less valuable when interest rates are moving up. As I pointed out last Thursday, interest rates started moving down a little bit. Does it sustain itself in that downward trajectory? Well, markets are up as a result a few days later. Remember when I said to you earlier, the bond market is ahead of the stock market? This is a perfect case in point in real time, as we saw the last 3 or 4 trading days. Now, our outlook moving forward, what are we looking for? What matters? Well, number one, earnings stay on track, and we want to pay attention to what the guidance looks like, right? What CEOs feel, are they confident, less confident? Again, what do they feel about the business environment? Again, business environment probably looks crummy, but relative to the animal spirits of what they have to do to stay competitive in other businesses in their same sector, if other businesses are spending money on CapEx, think AI and buying chips to stay ahead of this boom right now that we're seeing. And we believe in the AI space, we're in the basically 2nd or 3rd inning. We've got multiple decade expansion to go on that because we just started. And that's important. So we're going to pay attention to the conference calls and the earnings calls as it relates to that guidance. That's more important, what companies are doing to stay strategically competitive moving forward and how they're spending their money versus these short-term sort of headlines on a negative basis from, geopolitically, which is terrible to see. We realize that and we understand that, and we're not, dismissing that by any stretch of the imagination. But our job as capital allocators, as investors, as protectors of our clients' investments, we have to parse through what is true headline and what matters most to the markets. Number one, it's the earnings, and then as long as they stay on track, we'll be fine. Number two, as I discussed before, the Fed and inflation. We have a new Federal Reserve chairman, is Kevin Warsh, and he's going to be May and June. I think the first Fed meeting, we could see a nod to the presidential, hey, you nominated me, I'll give a 25 basis point reduction, which is, again, lower interest rates. That's better for earnings. That's better for the market moving forward. And as long as inflation stays in check, I think we could see that. But I also think Warsh is going to be absolutely independent. I think if you give it time, maybe even a year from now, I can pretty much say that I'm sure President Trump will be upset with this next Federal Reserve chairman as he is with the current Federal Reserve Chairman. I don't think that's going to change. I think that's just in the DNA of that sort of that fight. But the Fed has to stay independent to remain any sort of credibility. And again, it's also their two mandates are fighting inflation and basically price stability, as well as unemployment, and making certain that's as robust as it possibly can. I think employment could see some softening moving forward. That's going to clear the deck for the Fed to be more accommodative and less restrictive on their policy measure. So lowering interest rates into the summer. Again, that's another positive, as I'm pointing out, believe it or not. And then number three, don't forget about this. Last year, Congress passed the One Big Beautiful Bill, which right now is about $150 billion in tax refunds. It's April, not a fun time for tax time, most likely. But for most Americans right now, they're going to see sort of some relief. And that's going to help on both on the economy, because I don't know about you, but if somebody gets a tax refund and they get that check, are they going to put it in the bank or are they going to spend it? And they're going to spend it, it's going to go right back to the economy, right back into corporate earnings, and that could help sustain. Now, why did Congress do this last year? Well, it's no secret. This year is an election midterm cycle, okay? And so both Republicans and Democrats wanted to give some money back to their constituents, if you will, to say, hey, don't forget about me at the polls. And so it makes it a little bit easier for them on the kitchen table economics when they get a little bit more of their own money back, if you will, for the most part. And so that was done very strategically. Washington's very strategic. Now, hey, Rob, what about that $150 billion going into the system? Isn't that inflationary? Well, it is and it isn't. And the reason why I say that is we have a midterm coming up. That could be a short-term spike of that funds going into the economy. That's short-term inflationary, but it's not long-term sustainable because you don't have that reoccurring, if you will. It's a one-time hit. The second thing is the midterms. Now, if you go back to what I referenced before, and that was 95, 96, 97, 98, 99. Those are the 5 years of go-go years of best performing 5-year stretch of the S&P 500, historically speaking. Why did that happen? That's because you had the Democrat-controlled sort of Washington, and then in 95, so you had Bill Clinton in the White House, but in 95, in 96, you had the Speaker of the House, Newt Gingrich, come in, and the Republicans retook control of the House of Representatives. All that meant was it stopped spending in Washington, right? So we could see that play out again. The House right now, I'm sure if we voted today and we counted them up, the Republicans would lose the House, and that would stop. A divided Congress, historically speaking, is very positive for the stock market, as evidence, as I just showed, the most recent time. And a couple more times between now and then it's happened, and markets actually outperform. And so that's another positive. When they can't spend money, that is good because it reduces the cost or the obviously the carrying cost of our debt, but it also reduces inflation over time. And we need to take some time in terms of spending because we had so much spending over the last 5 years. It's not even imaginable. So that's a good positive that we see playing out at the end of this year. But in the meantime, there's money that's going to be injected in the economy, going to corporate balance sheets, again, keeping earnings in the forefront and stable. So sectors to watch right now. Technology and financials to rebound as interest rates fall. Those are two that will do really well. And energy is going to remain strong moving forward, regardless of a deal in the short term or no deal. Again, that's an evolving conversation. We pray and hope that comes to a resolve sooner than later. But longer term, from an investment point of view, energy is in play. Again, we've had energy exposure for our clients over the last few years, and now it's really hit year to date, but we consider it to be very strong moving forward for all the obvious reasons, so on and so forth. So that's it for today. Thank you for watching Again, like, subscribe, share it to friends and family. But that's our outlook right now, what we saw for the first quarter, but for what we could sort of preview for this next quarter. So again, let us know if you have any questions, thoughts, review your portfolio, update your financial plan. We're here for you at Blanke Schein Wealth Management. Thank you and have a great day.
Blanke Schein Wealth Management is a group of investment professionals registered with HighTower Services, LLC, member FINRA and SIPC, and with HighTower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities, LLC. Advisory services are offered through HighTower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Blanke Schein Wealth Management and HighTower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Blanke Schein Wealth Management and do not represent those of HighTower Advisors, LLC, or any of its affiliates.